Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a comprehensive ratio analysis problem. This will be part one of the problem, in which we will be comparing and contrasting two company data, having the financial statements of the balance sheet and income statement for those two companies, then running ratio analysis on both of them and doing some comparison between those ratios for the two of them. We will be grouping the ratio analysis into the categorizations of profitability ratio, asset utilization ratio, the liquidity ratios, and debt utilization ratios. We'll start off with the company A in this presentation, then we will calculate company B and talk more about the comparison between the two companies in the following presentation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are on the 347 tab, the Comprehensive Ratio to Companies tab under the Practice Problems section. Closing this back up, we're going to have our information for the practice problem, which will include the financial statements of the balance sheet and income statement for the two company data sets we will be working with, that being company A and company B. For this first half, we'll be concentrating in on the data set for company A. Then we'll move to the second half being data B, doing similar calculations and then comparing and contrasting the two. Balance sheet, of course, as of a point in time, assets, liabilities, owner's equity involved in the balance sheet. And then we have the income statement for company A and company B, which will be the performance statement, how well we have done over time. So we're going to scroll back down. We're going to be looking first at company A. This is going to be a snapshot or a smaller shot of the company A financial statements, where we have the balance sheet, the total assets here, total liabilities and equity. This is the second half of the balance sheet. Then we have the income statement, where we have the sales top line, the net income on the bottom line. We're going to first go through, as we say, calculating for company A here. And then once we go through all the ratios for company A in a following presentation, we will then do the same calculations comparing and contrasting to B. So then we'll be looking at B company here, and then we can compare and contrast the ratios for the two companies. So scrolling back up top, we will then say that we have the profitability ratios. These are going to include the profit margin ratio, the return on assets or ROA, and the return on equity. So scrolling back up, we're going to start off with the profit margin ratio. Profit margin ratio is going to be the net income statement number taken from the performance statement here. Bottom line number divided by the top line number, sales. Sometimes you'll see this as net sales. Don't confuse that with net income. It's net of any contra sales account, things like a discount or something like that would be in the sales section. So there we have that. Also note, it's also going to say credit sales here, just because we're pulling that from the sales item. That's just an indication that all the sales happen to be on credit sales, meaning they're not cash sales. They went through accounts receivable, not relevant for this particular ratio, but just note that that's why it is there. All right, so then we're going to calculate this out, and let's do the division. I'm going to practice doing the division so we can practice seeing the rounding and take a look at the transfer from decimals to percentages. 84,700 divided by the 1342000 is going to give us, if we move the decimal two places over, the 6.31% about 6.31. That means that this company is, for every dollar sale, on average, they're getting about 6.31 cents, or for every $100 in sales, they're keeping about $6.31. Now, obviously, we would like this to go higher. If we can increase the profit margin while not decreasing the volume of sales, that would be great. The higher number would be better. Is 6.31 good? Depends on our past performance. Depends on the industry standard, both in terms of the actual number and in terms of the trend analysis we have had up until this point with relation to it. Then we have the return on assets. This is similar to the return on investments type of formula that you might take a look at when you're thinking about an investment type of decision. The assets being what the company has. If we look at our financial statements, note total assets are basically what we have in the company, And why do we have it? In order to generate revenue. That's going to be the point of us having the assets. How did we get the assets? Well, either we generated revenue in the past or the owners have contributed to it. That would be the equity, or we took out a loan of some kind in order to help us to generate those assets on which we can generate the revenue. So we're going to compare our assets to the return that we have on them. So we've got the net income. That's going to be the bottom line income statement number. This is a performance calculation as compared to the assets, what we put into the company, what we had in order to generate that revenue. That's going to give us our return on assets, or ROA. Dividing that out, we're going to have the 84,700 divided by the 773,900. If we move the decimal 2 points over, that's going to be the 10.94% about. 10.494% about. Once again, we would like to have this number be higher. The higher, the better. Why? Because obviously we want the net income, the return that we're having over time, to be high as compared to the assets. So you might say, don't I want the assets to go up too? You do, but note that the assets are used in order to generate the revenue. So if we can generate revenue with less investment, with less assets, that would be good. If we can have less assets and generate the same revenue, that would be great. Our goal isn't to compile assets in the company. That's not the goal, because if the assets are not useful to the company, remember what we want to do is give them to the owner, basically in form of dividends. So the owner can then take those assets and possibly put them somewhere where they can actually return, have a greater return on the investment. So that's why we want the income to be going up, and we'd like to be able to have revenue generation, a return with less assets if possible. And then we have the return on equity. Return on equity calculated as net income. Once again, taking the net income number. Also note, by the way, if I go up to this return on assets, net income is an income statement number. Assets is a balance sheet number. So you might see this calculated as net income divided by average assets, which would be the beginning of the period plus the end of the period divided by 2. Depends on the context of the question as to when you're, whether or not you're going to be needing to calculate an average. That'll be the case anytime you have an income statement account and a balance sheet account due to the timing difference of a range in time versus a point in time. Return on equity is going to be the net income divided by the total stockholders' equity. So net income, once again, on the income statement, total stockholders' equity then on the balance sheet. So you have that same situation where you have an income statement number, time range, balance sheet number, point in time. Therefore, you might see this calculation as net income divided by average stockholders' equity, or average equity, which would typically be calculated, the most common calculation being beginning of the period plus the end of the period divided by 2. So just be aware of that. So then we're going to do this calculation. Let's take a look at it just so we can practice the rounding and whatnot related to it. Pulling over the trusty calculator, we've got the 84,700 divided by the 553,300. That's going to give us, if we move the decimal 2 places over, the 15.31 about %. Now, once again, we want this to be higher the better. If you think about the equity section, notice if we have assets here, the assets are comprised of, or people that have claim to the assets are either third-party folks, which are the liabilities, or equity, which is kind of like the owner. Or in other words, if you take the assets minus the liabilities, you would get then the equity, this 553,300. And so that means that this is kind of like the value that the owners have of the company, the book value of the company to the owner, assets minus liabilities. And therefore, once again, you would like to get a return on equity on this. So that means that the net income, we would like the net income, our return, to be as high as possible as compared to an equity, if we have less equity, that the investment to the owners, and we can generate the same revenue, that would be beneficial. Now, you have to be careful about the equity, though, because notice that you want to be careful when calculating this on how much liabilities are included in the calculation, as well as we'll see when we do some of the comparisons. So, in other words, one way to lower the equity would be to take on debt and still have the same assets for the return to get a return on, but you want to be careful on how much debt would be taken out as well. So that's something to consider when you're considering the performance of the return on equity. Now we'll take a look at the asset utilization ratios. This will basically be our turnover ratios, so like the receivable turnover. Then we'll calculate the average collection period, the days receivable outstanding. We'll do that 2 different ways. Inventory turnover using sales, fixed asset turnover, total asset turnover, this being kind of like the overarching turnover, this being, of course, related to total assets. And then, like we say, we saw some of the asset turnovers within them, including fixed asset turnover, inventory turnover, and the accounts receivable turnover. So let's start with the AR turnover, accounts receivable turnover. We got the sales. Notice all the sales are credit sales. This is when this is applicable, meaning these aren't sales for cash. These are sales on account, meaning they're going through accounts receivable, meaning, for example, we invoice the client and we expect to get payment in the future. If there are cash sales, then we may have to figure out the portion of the sales that would be credit sales for this particular calculation. Then we're going to divide that by the accounts receivable. That's an balance sheet item over here, representing how much is due. We have an income statement item and a balance sheet item. Those are 2 different timing frames. Therefore, you might see this represented as net sales divided by average accounts receivable, most common average, beginning of the period plus the end of the period divided by 2. So then we're going to divide this out. So let's divide this out. We're going to take the 1342000 divided by the 184.4, and that's going to give us the 7.28 about. If we round it out, we're not going to make this a percent. And notice it's over 1. So if some of these ratios are less than 1, then that's kind of why we make them a percent sometimes, so we could see more data, And then, so this one's over 1. That means it's turning over 7.28 times the receivables. Now, these turnovers, we always want them to be higher. We'd like the turnovers to be higher. That would mean that we're turning over the receivables more, which is good because we would be receiving money faster that way if we're turning over the receivables higher. So obviously, if you think about the calculation, we would like the sales to go up. That's the performance number, top line now of the income statement. And the receivables, if the sales are higher and the receivables are lower, that would be good because that would mean that we're actually collecting on the receivable faster, which is what we want to do. Faster we can collect on the receivables, the better our cash flow and the more likely we will be able to collect on them. However, 7.28 is kind of an abstract number. Is that good? We'd have to depend or compare it to past performance, trend analysis in a past, industry standard as of a point in time, and trend analysis, our data compared to the industry data. Then we have the average collection period. So once we know this number, we can calculate the average collection period by taking the days in a year, which may be 365, which people probably has memorized as a fairly close day, a number of days for most years. Or you might try to even it out by saying, I'd like to have even units of periods. So 12 months times an average of 30 days, which would be 360. Be aware that you could see either of those calculations, either of those numbers, depending on what you're working with. We're going to divide that by the receivable turnover, which we just calculated. So 360 divided by the 7.28, that's going to give us the 49.45, 49.47. Notice we used, there's rounding involved here. So 360 divided by 7.28 is 49.47. So there's some rounding involved, and we did this in Excel. You're always going to have to deal with rounding that's going to be involved in these items. I highly recommend working these in Excel along with the practice problems so you can practice on those rounding issues. And in practice, however, of course, you're looking for something that is an estimate. These are all estimates in practice. So how far out do you want to round them? How are you going to deal with the rounding issues? Well, it depends. On how accurate you need the numbers to be, because you're going to have to round them somewhere. All right, so there's the 49.47. That means how many days the accounts receivable are outstanding. This is kind of a more concrete number. It's nice to be able to present a number like this because it's easier for normal people to basically just understand, okay, they're averaging 49 days. Obviously, this ratio, we would like to have less. Meaning we would like to have the receivables outstanding for less days than this. So we always want to decrease that number. We can also calculate that average collection period this way, which I think is a bit more intuitive for most people, that being the accounts receivable net. So the accounts receivable, remember when we say net, we just mean net of the allowance for doubtful accounts, which would be a contra account if they're estimating how much of the receivables we think are uncollectible. So we'd have the accounts receivable minus the allowance for uncollectible receivables. That would be the net receivable. Then we're going to calculate the sales per day, which would be the sales number, sales on credit here. And then we're going to take that and divide by the number of days in a year, which we're going to round once again to 360, which would be 12 times 30. And that's going to give us our sales per day. So if we divide this out, we're going to be taking the 1342000 divided by 360. That's going to give us our 3727.28 about. And then once we have our average sales per day, this is how much we are selling per day on average on credit sales, meaning not cash sales, but credit sales, which we're assuming all of them are credit sales. Then we can take the 184.4, the receivables divided by that 3728. And that's going to give us, once again, that 49.47 about, 49.47 about. Next, we have the inventory turnover. So inventory turnover is going to be comparing the sales, and so we're going to be comparing the sales and the inventory. Now, note that the inventory turnover, you might be using here the cost of goods sold. Also note that it says credit sales still because we're pulling that from this credit, the credit sales, because all the sales are credit sales, but it would just simply be sales if you're using sales, or cost of goods sold. If you're using cost of goods sold, you're going to need to know the context of the calculation in order to make that determination. And also note that we're comparing sales to, which is an income statement account, to inventory here, which is a balance sheet account. Therefore, you might see this as net sales divided by average inventory, which would be beginning inventory plus ending inventory divided by 2. So if we do this calculation, then we're going to say that we have the 1342000 divided by 57.4. So we have 23.38 about. This is something, once again, that we would like to be higher because this is basically showing how many times we're overturning the inventory. We would like to turn over the inventory faster. The faster we can turn over the inventory, the more revenue we're going to be basically generating. So if you think about it, obviously sales, we want sales to be increasing, and we want the inventory it to be turning over as fast as possible. So we don't want the inventory to be sitting basically on the books. Now, again, you have to have some kind of cushion here because you got to think, well, I need to, do I want a just-in-time systems where I'm turning over the inventory and I have a very little amount on the books at any given time? But then if there's a lot of sales at some points, you might not be ready for that. So you have to take into consideration the industry, the fluctuation of the industry, and taking into consideration any unusual components that might happen. But typically, we want this turnover to be higher. So then we're going to say next item is going to be the fixed asset turnover. Fixed asset turnover is going to be the sales. Once again, it says credit sales, but we're just picking up the sales because that's the top line of the income statement compared to the fixed assets. Could also be called long-term assets or property, plant, and equipment. Fixed assets, depreciable assets, PP&E standing for property, plant, and equipment. That's going to be here on the balance sheet. That's like a buildings, the equipment, and so on and so forth. We could have the depreciable assets themselves minus the accumulated depreciation. So we're taking the net or book value of that categorization to see how efficiently we're using those fixed assets. Let's do that calculation. We're going to be taking then the 1342000 divided by the 402 to 100. That's going to give us the 3.34 about. Once again, these turnover ratios, we would like them to be higher rather than lower. We want them to be going up. That would mean we're using our fixed assets more efficiently. Meaning, if sales goes up, we want sales to go up, of course. And if we can have sales go up with the fixed assets where they are, or even less fixed assets, then we would have less, we would like to be able to lock up less items in the fixed assets, which are long-term capital investments, if we could, and still generate the same return. So once again, the higher the better on this number typically. And is that number good? We'd have to compare it to past performance, industry standard, trend analysis from our past, and trend analysis as compared to the industry. Now we have the total asset turnover, which is kind of encompassing all these other turnovers because we're talking about total assets here. So we're going to take the sales, once again, sales income statement number divided by total assets balance sheet number. Therefore, you have an income statement and balance sheet number, two different timing segments. Therefore, you might see this as net sales divided by average total assets, depending on the context. Notice we're focusing in on A here. I included B, but we're focusing in on A. So ignore the numbers to the to the right. Maybe we'll do it this way. We'll say we're not looking at those yet. All right, and then that's going to give us the total assets turnover. So then if we do the calculation here, we're going to say this is the 1342000 divided by 773900. That gives us the 1.37, and the 1.37 is the total asset turnover. Once again, we would like this to be higher the better, because we would like the sales to be going up in relation to the total assets, meaning. And so you might say you want the assets to go up too, don't you? We do want the assets to go up, but note that the assets are what we're using in order to help us generate revenue. So if we can generate the same amount of revenue with less assets, total assets, then that would be good. And then possibly we can take some of those assets and give them to the owners in terms of dividends, and they can find a return elsewhere on it if they're not necessary in order for us to generate a return. So that's kind of part of the thought process you would have on there. So our goal isn't just to compile assets, just to compile assets. If they're there for a purpose, which could mean a purpose such as safeguarding against problems in the future. So we might have cash on the books that we're not using right now, for example, that we might think is necessary in case there's a catastrophe or something, to be more kind of conservative in that. Then we're still using it in order to generate revenue in the future by safeguarding against a potential problem or safeguarding against risk. But if there's no use to it, then you would think you'd want to distribute it possibly to the owners. So, all right, back to next items we have are liquidity ratios. Common liquidity ratios, the current ratio and the quick ratio. So current ratio, this is basically how well can the company pay off their debts, basically. So we have the current assets divided by current liabilities. The current ratio, one of the more common ratios that people know. The current assets are going to be on the balance sheet in terms of the assets section. That's why we break out the current assets versus long-term. Current assets are more liquid assets, closer to cash, things that we're going to consume shortly or that can be converted to cash easily, including cash, accounts receivable, and inventory. And then the current liabilities are going to be those things that are due within a year. Therefore, we need to make sure that we have enough assets, liquid assets, that we can then pay off those liabilities in, because they're going to be due within a year. So we're going to be comparing the current assets and the current liabilities. If we divide that out, we're going to say we have the 371,800 divided by the 137. That's going to be the 2.71 about. That means that we can pay off the liabilities 2.71 times, almost 3 times, 2.25 times off with the current assets that we have. So the higher the number this is, the better for the banker. You'd still want to compare this for if you wanted to get a loan, in other words, the higher this is, the better the banker. You still want to compare it to industry standards, but bottom line, this thing should be over 1 for just about any company, you would think, because if it's less than 1, that means your liabilities are greater than your assets. And these liabilities, or your current liabilities, are greater than your current assets. These liabilities are due in a year, so it doesn't look like you have the funding at that point to pay it. So you'd want, so you might have to take some action if that were the case. Now you might say then, well, the current ratio is including things like inventory. And what if there's a crisis? You wouldn't be able to sell the inventory. And so I'd like a more restrictive ratio, if you're the bank, possibly saying, to make sure that they can pay off the debt. So we might then say, let's compare the quick assets, or acid assets sometimes called, to the current liabilities. So we can do that calculation, which would be something like this. We would take the 130,000 plus the receivables, 184,400. That would be the 314,400, not including the inventory. Or we can take the total current assets, 371,800 minus the inventory, 57,400. That would give us our 314,400 as well. We're going to compare that more restricted assets, the quick assets, to the same current liabilities, those due within a year. In this case, accounts payable. So that's going to give us our ratio. Let's compare that out. That's the 314,400 divided by the 137,000. Gives us the 2.29. So we could still pay off the current liabilities, even if we got rid of inventory totally, 2.29 times. This is a more restrictive ratio, therefore it will always be lower or even to the ratio up top at the 2.71, meaning if they don't have inventory, it might be the same. It wouldn't be worth calculating possibly. But if they have inventory, then this ratio is always going to be less, because that's the point. It's a more restrictive ratio. So then we have the debt utilization ratios, which are going to include the debt to total asset ratios and the times interest earned ratios. So now we're focusing in on the debt. So the debt is going to be the liabilities. Debt, we're thinking total liabilities, including the current liabilities and long-term liabilities here. So we got the total liabilities would be the 22600. That's on, of course, the balance sheet as of a point in time. We're going to be comparing that to the total assets. It is exactly what it says here, right? Debt compared to the total assets. Total assets is going to be here on the balance sheet. So that's what we have. So remember the accounting equation. This is what we have, assets. We can allocate those to who has claim to them, liabilities, third party having claim to those assets, and the equity having claim to those assets, the 553,300. So therefore, if we find the debt compared to the assets, we can also find the equity compared to the assets, and we're kind of comparing and contrasting how much of these assets are being allocated to basically those two categories, those two groups on a percentage basis. So if we do that, then we're going to say, all right, we've got then the 220,600 divided by the 773,900. Moving the decimal 2 places over, that's going to be the 28.50, about 28.5%. If I subtract that minus 1, this is going to be the amount that is on the equity side of things. Equity's claim then would be 71%. So of the assets, the liability has claimed to 28.5, the equity 71. Is that good or bad? You're going to get different conclusions from different people, right? Because you remember, what we want to do is if we can increase assets and that would increase the return, net income, meaning if we think that if we had more assets, we can increase the net income, then you can see people obviously arguing that maybe we should take on more debt in order to do that, because as long as we can pay off the interest on it, then we'll be generating a higher return, even though and that would be increasing the leverage of the company. However, if you get past a certain point, then you're increasing risk with the increase of debt, which means that if there's a problem in the economy and sales go down, so you can't make any net income anymore, and then you look at your balance sheet and you're over leveraged, meaning a lot of the assets are claimed by the third party, it's less likely that at that point in time you're going to be able to get a loan. So it's a risk versus reward kind of calculation. So once again, you need to compare it to industry standards and kind of the standard analysis for debt to asset type of ratio for the industry that you are in. Then we have the times interest earned. Times interest earned calculated as net income before interest and taxes. That's going to be an income statement item. We're focusing in on the interest. We want to see how many times over we can pay the interest based on our earnings. So what we need to do then is take our net income and back out the interest so that we can then see how many times over we can pay it, because the interest is already included in the net income. We're also going to back out taxes, because interest expense has an effect on taxes, and taxes just kind of muddy up the water, so it's easier for us to just remove the taxes and the interest to do this calculation. If we do that, we'll get back up to this operating profit due to our multi-step income statement, but it's useful to calculate this from net income, which would be 84,700 plus the taxes 69,300, which is this item, plus the interest 10,000 to get to the 164,000, which is basically our operating profit. It is our operating profit number. And that's because that's our multi-step income statement, how it's formatted, but you don't want to memorize it typically as operating profit, but rather net income before interest and taxes, so that you know what you're doing no matter what type of data is given to you. Then we're going to divide that by the interest, which is like the rent on the loans that we have out, to see that if we can pay the minimum obligation of the loans that are taken out. So we got the 164,000 divided by 10,000. So we can pay off the interest expense 16.4 times over. So once again, a bank, if they're thinking about giving you a loan, would like this to be higher. The higher, the better. Just like if you're going to rent, a building or something like that, the landlord wants to know how well you can pay off the rent to see how likely you are to actually pay the rent. The same with the renting of money, which is the interest on it. So the higher this number is, the more likely the bank would be happy about, loaning more money. Now, next time we're going to move on and we're going to go through these ratios again, calculating them for B, the second company, and then we can do some comparison between the two.